Eric Muathe, Muathe.com, here with a quick review of the market, and it is for January 11th, 2017. So market's been higher. The Dow was higher earlier on, about 100 points. Let's take a look at this chart, see what's going on, and it's going to be a brief one. I want to update you on what I'm looking at. Take a look at the NASDAQ daily right now. We see that on the daily, this is where the NASDAQ is showing some level of resistance on the daily chart. And keep in mind that level happens to coincide with this break. That break there is one we've been watching since. I could have drawn it somewhere else, but that's fine. So this level here has been a problem, and I'll show you that evidence of that problem. So this red line represents where the NASDAQ's been stalling, albeit for short-term pullbacks. Resistance here for the highs there. This band of resistance for the highs here. And now we are coming back. As of right now, if the market is down for the day on the NASDAQ, that is where it looks like resistance on the same level. Now, keep in mind, it's not a trivial issue here. The fact that the market made all-time daily closing highs on the NASDAQ as of yesterday. But the technicals, so let me clear that off. So it's not a trivial development here. You are making improvement in price highs, but at the expense of your technical strength. That negative divergence tends to be very instrumental in pulling instruments lower. Let's take a look at the weekly for the NASDAQ, and we are seeing something here that if you really just pause and reflect on this, what the market is doing is just taking its time. But this has been a problem, continues to be a problem on the weekly chart. As long as the market is unable to move the NASDAQ above this level, the more this looks like where it stalls. Let's take a look at the Dow, DJIA, and I want to take a look at the hourly. And the hourly, as of right now, is showing that this is where it is stalling on this top side on the hourly. Just at the highs of the day, it got smacked back down by this line. We take a look at the S&P 500 and the weekly chart for the S&P 500. In fact, let's take a look at a 3-year weekly chart for the SPX without adding anyone's opinion on this. Right now, if this is what the market is doing without knowing what the next day, the next week is going to bring, as long as this is being rejected as the market made new highs. Keep in mind also here on the S&P 500, one can argue that the highs have come with the expense of the technicals not following through. We made a higher highs on the weekly. Technicals have not really made an improvement, so I can draw that. So the technicals are lower. Again, we see another negative divergence on a different setting. It's not good as long as that remains the case. Take a look at the daily for the S&P 500. We also see here we made an improvement day to day to all-time highs at the expense of the RSI. Here we see another time frame showing negative divergence. Don't forget that the S&P 500 on the hourly also made an improvement hour to all-time hourly closing highs at the expense of the RSIs. Another time frame showing negative divergence, in other words, running out of technical strength. Now all these things point to a market that could pull back. But as I've been saying for a while, as long as the Dow weekly RSI continues trading above 69.1, this market continues to be sideways to bullish. As long as the Dow monthly chart continues showing the RSI on the Dow monthly above 69.1, this market continues to be sideways to bullish. That's just how it's going to play out. Now, the one thing we can see here, take a look at the SPX on the monthly. As of right now, S&P 500 has not been able to reclaim the level above 69.1. Now let me It's been a while since I discussed this, but let's go back a couple years here on the S&P 500 monthly. The reason why we have to watch that level above 69.1 is because the last time it moved above 69.1 was here at the beginning of 2013, which is during this breakout. So this price breakout here on the monthly coincided with the RSI moving above 69.1. The market essentially held above that until here, which was almost 2 years later, which is during this period. So reclaiming this level is a big deal. And so we go back to the Dow. This is why it's very important that we do not underestimate the importance of the Dow holding above 69.1. As long as the Dow is above that threshold, again, this market is going to be sideways to bullish. If the Dow fails to hold above 69.1, then we can start looking for more evidence as to why the market is setting up for a major drop. Now, I wasn't going to talk about stock picks because Sunday's video and yesterday's video do go into details. Again, Sunday's video and yesterday's video, lots of ideas, but I want to talk about that steel sector. In fact, let's take a look at the steel sector from a same monthly chart as that we've looked at the Dow and the S&P. So the steel sector, and I'm going to keep hammering this point, is coming back to test this RSI level. This is make or break. There's no doubt about this. This is either a break area or make. It cannot be both of them. Above 39.27, steel sector is gonna have some major returns to the upside. Okay, so as long as the steel sector is above 39.27, absolutely money is going to be made in the sector. But I also have to caution you, based on the monthly chart RSI, that failure to hold above this number for me means that one has to find, not has to, but one can consider taking an aggressive sell position or short position as far as the steel sector is concerned. That would be my scenario of break. So that would be the break situation. And the reason why that's a big deal is failure to hold above this number suggests that this is being confirmed as resistance, and that's a major sell signal. So let's take a look at this here. Failure to hold above this line, failure to hold above 39.27, and one can consider that the next meaningful, and I mean a big drop, will take place once this fails. Whee! So there's money to be made if this fails, and there's money to be made if it can break out, because so there's a scenario here is either it is gonna advance above this blue line for a major move higher, so that's the make situation, or it moves back above that number of 39.27 and money is going to be made shorting the steel sector. The last time we saw something similar to that is GLD. If you recall my videos at the time, fat fingers I guess. If you recall my video here, right there, I was not too excited about the potential for higher prices. Anybody who took advantage of those comments and took advantage of resistance on this line would have had a chance of making some money in shorting gold and gold stocks over the last couple of months. So that's the same situation for steel sector. They might be faking people here, which is pretty much what I'm leaning towards, but you're gonna know this is the case once it moves back below 39.27. Watch this number. Don't short the stocks. And what stocks am I talking about? You can take a look at yesterday's video, or you can take a look at Sunday's video. All the steel sector stocks are gonna be sell candidates if this is the case where it moves back below and fails to break out. So failed breakout here would be the signal to go short the steel sector. But don't try and be cute and do that while SLX is moving above 39.27. It's make or break time, folks. I'll keep you guys posted. Eric Muathe with Muathe.com. And as I always like to do before I let you go, here is how your markets are trading. Let me process the video, upload it, and send it to you guys. Otherwise, see you on the other side. Peace and blessings. ESCS. Woo!